Now that we've taken a quick look at what's going on in the markets, let's turn our attention to some important numbers that are being released right now. I'm talking PPI and retail sales, and to help break us down, we're bringing in Scott Bauer, CEO of Prosper Trading Academy, to the show. Scott, I'm looking here at the numbers as they're coming through. I don't know when I look at first core PPI that anything's coming one way or the other. Month over month came in a little bit on the positive side here. The actual of 0.8 versus estimated 0.6. Core PPI month over month 0.7 versus 0.5. And then PPI year over year 6.6 over 6.3. And then finally core PPI year over year 4.8 in line with the estimates. Anything from your side on the PPI side that changes or moves things around?
You know, from a first glance, JB, it looks just a teeny bit hotter than expected, but we've seen that over the last few reports. Anything that we've seen has been a little bit hotter than expected, and the market has taken it in its stride. So we probably have to break this down a little bit further, but on first glance here, kind of what's expected tells us that the market is still revving along. Inflation is there, even though the bond market obviously is not reflecting that so much right now. But it's not a blowout number. It's not one of those numbers so far away from expectation here that I think it's really going to affect the market.
No, if we turn our attention here to retail sales, I'm looking at these numbers here as well. Retail sales coming in maybe a little bit on the light side here, purely coming in at down 0.7% versus down 0.6%. Right. So a little bit along the line where it is. I guess the question here is you're looking, here we go, right here. So actually here's the details of it. It's a little bit better. So
there we go.
Yeah, there it is. Down actually 1.3 month over month versus the estimate of 0.7. Core down 0.7 versus an expectation of up 0.2. But then overall, as you take X autos, et cetera here, again, doesn't seem to be pushing it one way or the other. I mean, I think a little bit of a disappointment, but nothing too big.
Yeah, but a disappointment, I think, is probably a good thing, if you will, for the market. I mean, we don't ever want to talk about, disappointments necessarily as being a good thing, but this is certainly what the market would be looking for going into the Fed, announcement tomorrow. I mean, it's, I don't want to say it's a Goldilocks number, but it's a not move the needle sort of number, which is probably exactly what the market needs right now.
No, and I think that makes sense. And you're kind of seeing that in the markets. I'm looking here right now, nothing really moving one way or the other, especially in the indices. But I want to turn our attention away from the numbers. Obviously everyone's talking Fed and getting ready there, but you actually brought it up right off the bat. You brought up the bond market and the treasuries. And I thought it was interesting. As I was doing some research and looking at stuff, the 2-year yield yesterday hit its highest level in a month, and then the 10-year almost got to 1.5. Now, always think great about doing research is it does a good thing when you look at there, you feel like you're in a good spot. I come in this morning getting ready to ask you about NASDAQ hitting highs and SPOOs hitting highs. And oh, by the way, now I'm looking at the 10-year. The 10-year came off. It's back up here at about 1.5. What are you seeing when you look at the treasury market? Because I think these are the ones that people maybe aren't paying as much attention to as they really should.
Yeah, they're not. And I think that the bond market, quite frankly, is in a state of flux, waiting really to see if there's going to be any words tomorrow, or if the tapering, verbiage that we're going to hear, if that's going to be August or September. So I think the bond market right now is really just gyrating back and forth. It's very surprising to me that actually that we've seen these rates come off as they have, because, at the end of the day, JB, what's the difference if the Fed mentions something tomorrow or if they mention it in 2 to 3 months? There really is no difference to me. So it's surprising. The bond market does typically kind of tell us what's going to happen here. But at this point right now, I think the bond market is just shrugging its shoulders. I really do.
Yeah, I mean, it's interesting. I was just looking here at a quick little real tight chart here, a 5-minute chart, and I was looking here, and you have a big sell-off coming off that number, which my assumption is associated with sort of, like you said, that sort of non-market moving number here. But the notes in the 10-year there especially was coming off a little bit, which is driving those yields up. I'm looking here again. We're sitting that back over that 1.5. I guess my question as I look at this is the last couple of times we've gotten spooked over 1.5 or 1.6, it's really taken the wind out of the marketplace. It doesn't seem to be doing that anymore. Is this because we just have changed our mentality now? We understand that being in that 1.5, maybe even to like 1.75 is an okay place to be in this market?
There's no question about it. We all get numb to it, not just as human beings, but the market gets numb to it also. And one of the best times that I remember the market really just becoming complacent was a few years back. I think it was February 2017 when we hit 3%, right? That magic 3%. And the market absolutely, for the first time we hit it, we sold off. It was one of the bigger sell-offs that we've seen over the last 5 years or so. And then it just became kind of complacent. We see the same thing right now. The first couple times we hit 170, traders were freaking out. The market was freaking out. Oh my God, we're going to have a 15, 20, 25% drawdown. And then everybody becomes numb to it and realizes that, okay, it's maybe not the sub 1% environment that we've been in the last couple of years, but quite frankly, if the economy is doing well and rates are 1.7, even 1.8 or so, is that the worst thing in the world? And the answer, in my opinion, is no.
So I want to turn our attention here to another interest rate sensitive asset. Let's talk about gold. I mean, again, another pressure day on there. It had a little green. It worked it. I think it was the first time I saw green and gold together in a really long time, since maybe the fall when Notre Dame was playing. But now all of a sudden I'm looking here and we're back in the red again. It's coming in, pushing it off here again. Is there anything that can happen here when it comes to gold to be able to sort of transition it, or are we just going to see this constant pressure pushing it back down?
I think it's the same thing right now as we're seeing in the bond market, JB, is we don't really have that direction. Just, what was it, a couple of weeks ago when we were steaming 1900 and looked like we were, going to 1950, 1960 as those next levels. And then the market just kind of, lost all its momentum, lost its strength. I think we're going to hover in these, mid to high 1800 number here for quite a while. We'll see what happens after the Fed tomorrow. I don't think what they say tomorrow is really going to affect the gold market as much as it may affect the bond market, though you would think the two should be really highly correlated together here. But yeah, it's really lost some momentum here. But man, I would be a big buyer here on any further dip down to the 1830-ish area, which I don't think we're going to see.
Yeah, it's interesting when you think back to where we were at this time last year. I was just looking quickly at a chart here. We were actually lower, and we went screaming above 2,000 after that. So sometimes, we forget to go look a little further back than where we are right in the rearview mirror. And that was a heck of a move. That was almost one of the big trades for retail investors, was that gold trade. But I want to stay in the metals complex, but I actually want to look at where some other ones that have a lot of pressures, and it kind of surprised me a little bit of how much pressure. I'm talking silver, copper, palladium, and platinum. All of them have been under some really significant pressures after really getting big boosts to the upside. And I guess in a lot of these cases, these are manufacturing or housing-based products and metals. With the demand out there, I'm a little surprised that they're selling off as hard as they have. Do you have that same view, or am I just missing something here, which is totally possible?
No, I absolutely do. Especially, I'm going to isolate on copper. Copper's down almost 5% this morning here, and that's been one of the strongest metals, if not the strongest metal, as you just talked about over the last year, 18 months, as we've seen housing, just completely be red hot, and the production, the industrial side of this here. I think what we're seeing here is just some profit taking. I don't think there's anything fundamental that has changed over the last weeks or months to really see, this big drawdown. And this is a really big move for copper here. Again, I think this is one that if I see this trade down into the 420-ish, 425 range, which we're not that far away, I'm a buyer. But I think it's just profit taking again.
Yeah, it's interesting as I've been watching this, especially we have the rest of this week, housing numbers. We always talk about the importance of those metals and copper especially in there. It's just been an interesting sort of couple of weeks here to watch those move along the way. Another market's on the tear, and I know we're kind of shifting around, but I think it's important because it's also price sensitive. Crude oil. I'm just sitting here watching this as I think about all the impacts to prices and inflation. Scott, as I'm looking here, this is the one that we always kind of talk about, hits you in your pocket right off the bat. You already need a driving season coming in with the summer and reopening, et cetera. But I mean, crude really with a big old move here. It was up over $1. It's now kind of come back off a little bit. I'm trying to get the number here exactly. It's 71.66, so it's come back. Yeah. So I mean, it's come off a little bit, but I mean, you talk about a chart that's left to right and in a good spot. I mean, this is the chart you want to have and what you want to look at. I mean, is this coming down to now being supply and whether or not OPEC Plus in the U.S. start to actually increase supply? Or are we looking at 80, and in some cases I've heard $100 crude oil by the end of the summer?
This one is a big head scratcher, and I think this one is trying to get ahead of what OPEC and the U.S. supply, as you just said, what's happening here. The big thing to me is, U.S. producers, we were at 13 million barrels a day pre-pandemic. We're now down at 11 with not a lot of increase in sight, if you will, because I think the U.S. producers are being very, very cautious about the demand, about reopening here. So yes, we've gone from completely flip-flop from demand destruction, if you will, a year ago to now the big problem being on the supply side. It's obviously coming at the absolute worst time for consumers, for drivers with the driving season ahead of us here. And I'm not in the camp, JB, that we're going to see $100 oil. I really don't. I am in the camp actually where I'm fading this rally. I may be the minority. I may be wrong. I'm fading this. I think this is anticipating news out of OPEC. I think this is anticipating the worst. And I'll certainly have my stops in, but I'm fading this.
It's interesting. I think when I was looking at this, a lot of the news came up with the U.S. and Iran coming back to talk to you about the nuclear programs and the agreement. And the question was, oh, well, now Iranian oil will come into the marketplace and increase the supply. I mean, for those of us that don't think that oil was already out there, just not on the straight market, I think it's an interesting one. But I agree with you. It does feel like some point here that supply question's got to take a little bit of a breath out of it. But the last one I want to bring up to you, and I'm stealing Oliver's thunder here, and you know where I'm going, something on a tear is Bitcoin. I mean, it looked like it finally got that bid. We were talking yesterday, if it couldn't get above 40,000, that, hey, you know what? Maybe this is the problem for it. Now, all of a sudden, we're back down just barely below it. But we ripped through 40, and we were holding there for most of the night.
We were. And to me now, when we're going to see a little bit of a sell-off, I truly believe that. But to me now, 38 is a really big number in terms of support. That was the number that Bitcoin had a breakthrough on the upside to break through that resistance, and it hovered 40, 41. I believe we're going to get a little bit of a sell-off. We'll see volatility contract a little bit. If it can hold 38, JB, and volatility settles down and we get kind of that coiling or so, that could really be the start of that next move higher.
So Scott, I just want to get your take here. So we've gone through a ton of different markets. We talked about a ton of different movements, a lot of different things that are out there. And the reason I kind of like to do this is because obviously the eyes are going to be on the Fed and what comes up next. I guess my question, as you're sitting there viewing it and getting ready for this, for the meeting minutes and stuff to start to come out here, again, I know it's not today, it's going to be tomorrow. As an investor and a trader, how are you positioning yourself for this move? Because, for me, part of my concern is always you get a little too bullish or a little bit too strong in one area. Now, all of a sudden, you get that news or that number, and it really can start to hit you hard. Where are you looking, or where are you viewing as you prepare yourself for this announcement coming through?
So I have been, and this is my conversations with Ben, with Oliver, I have actually been long in the semi space for the last few weeks or so. I'm pretty much going to be flattened out going into this announcement. Not that I think this announcement is going to rock the market one way or the other, but you know what? With lower volumes, with summer trade right now, I'm going to be on the sidelines for the most part. And if I miss a move, even if that was something that was advantageous to me one way or the other, I'm okay with that. I'll hop back in. But I think this one is a critical number that is really up in the air. I don't know what they can say that would be ultra bullish, and I don't know what they can say really that would be ultra bearish. I think it's one of those announcements. So I'm pretty much on the sidelines here. However, I would tell you that I do think the semis can run a little bit further, but I'm going to take off what I've had on over the last 3 weeks, or at least pare them down considerably before tomorrow.
Well, Scott, it sounds like you are with the majority out there saying that this could be the most important Fed meeting for Chairman Powell ever, and eyeballs are going to be wondering and looking and listening to see what's coming up and where we're going. So I appreciate you coming on the show, breaking down not only the numbers, but hitting across all of the various markets and telling our investors and traders to be smart and think about what they're doing as you get ready for the numbers ahead. Thanks a lot, JB. Scott. Everyone, that was Scott Bauer, CEO of Prosper Trading Academy, joining us. When we come